The September's meeting of the American Fed is approaching, and the highly probable first cutting of interest rates in the United States comes with that. This event is widely expected among investors. The cut in interest rates means that we have overcome the crisis and that business financing can become cheaper again. The start of interest rate cut cycle in the US will have a significant impact on the development of the US stock market, and it offers us as investors interesting opportunities to value our capital above average. One of such options that has a great potential to outperform the S&P 500 index in the upcoming months and years is American small caps, stocks with a small market capitalization, most often represented in portfolios through the Russell 2000 index. Welcome to my Maneko Invest channel, and in today's video we will look at why small caps should outperform the S&P 500 index in the near future and how and in what quantity to include them in portfolio. After the past decade, it seems that investing in US large caps through S&P 500 is historically one of the most profitable investments an investor can find through index investing. During this time, the largest companies really significantly outperform the rest of the market in terms of returns. That is, to put it bluntly, they directly trampled it into the ground. Whether it was the shares of fan or somewhat modified group called the Magnificent Seven, under which the shares of Microsoft, Apple, Nvidia, Tesla, Google, Meta and Amazon are hidden, all technological giants and mega corporations operating worldwide, and many investors still ignore other parts of the market based on the past decade. However, in history, the situation is more of an anomaly than a learned-term rule, and these large companies can be beaten very easily in terms of performance by one specific group of shares, small caps, or shares with a small market capitalization in the following years. But why? First, let's look at the history. If we look at this graph in which we compare the growth of $100 invested in large caps in the green curve and the small caps in the blue curve from 1926 until the bottom of the last post-COVID crisis, we see a fairly clear result. Smaller companies, the big ones in the long-term scale, win significantly in terms of performance at the cost of higher volatility. But before you run headlong into investing half of your portfolio, let's talk about why small companies in the long run will yield more to the investor than large ones. After all, half of the companies in the small cap indexes like the Russell 2000 are not even profitable, so how can it outperform the big well-established companies that generate billions of dollars in net profit per quarter in the long term? The difference is in size. Apple, that's one of the largest companies in the world, had sales of $85 billion for the last quarter. In contrast, one of the largest positions in the small cap ETF with the ticker symbol IWM. The company FTAI Aviation had sales of only $450 million in the last quarter. That's many times smaller, but let's look at this issue from the other side. How much would Apple have to increase its sales to double them? Another $85 billion. And how much is enough for the mentioned small cap company? $450 million. And that's a much smaller and simpler task. Smaller companies have a much greater potential to increase their sales than large global mega corporations such as Apple. Going from 10 million to 100 million in revenue is not the same as going from 10 billion to 100 billion, and that's still a tenfold increase. It's also usually much easier for small businesses to expand into new markets, scale up, and attract new investors looking for something to get rich off. The quest to discover the other Apple, the other Google, or the other Microsoft is always and will be. After all of days today, some of the largest companies in the world were only a few decades ago those small caps companies. And those who invested in them back and preserved are today at least $1 millionaire in a pessimistic scenario. All these factors will then increase the demand for shares of such a company, and its values can thus multiply much faster than in the case of large companies. You must be asking now, if the company is really that successful, then after some time it will still be included in the S&P 500 index and I will have it in my portfolio, so why take the risk? Yes, it's true that the ultra-successful small caps, and there are a minimum of them, rarely get into the big indexes like the S&P 500. After all, the well-known company Palantir did this last week after several years. But from its listing on the stock exchange in 2020 to its inclusion in the S&P 500 index this September, an investor who invested in it at the right moment could already get a multiple appreciation of his investment. But it will be very difficult even for a technology company like Palantir to repeat such growth in such a short time. And that's exactly what it's about. A small and medium-sized company will rank alongside the big ones only after it has delivered to its investors several times the valuation of their investment, and with iron regularity, because otherwise it will not even get into the large cap indexes. And that's not to mention that if an investor I want to speculate on some newly discovered technology or a new type of product that's yet to be introduced or newly launched on the market, I have no choice but to invest in small companies, often startups. After all, excess income in private equity funds often lives on from this fact. Despite all this, we had a long period when small companies significantly lagged behind as big giants, in this case represented by the S&P 500 index, and to most investors today, this seems normal. After all, Magnificent Seven's shares these days represent more than 30% of the entire index. Despite their giant size, they have significant growth in margins, even when compared to the other 493 companies that make up the S&P 500 index. That optimism has taken it so far that even funds have started to be created that follow only the 7 mega corporations and completely depreciate the other stocks. This factors then suck in a huge amount of capital that gets into the American stock market from the side of investors, including the great popularization in quotation marks of passive investing in index ETFs led by the S&P 500. But this is nothing that we have seen in history. They have not seen this index. And if these large companies begin to do worse and fail to meet the often overly optimistic expectations of investors, then the invested capital will begin to move slowly. We have recorded this trend several times in history. Just as the economy has its cycles, performance also has its historical cycles. You can see in this chart that there were many periods, often lasting more than a decade, when small companies outperform large ones. And the last 14-year cycle, when the big companies significantly outperform us, may be coming to an end. By the way, on this chart we can see that the sliding 10-year difference in the returns between small companies and large companies in the US from 1926 to December 2021. Over this almost century-long period, small companies have outperformed large companies 65% of the time on a 10-year horizon, regularly much more significant differences than in the case of the dominance of the big companies. And during this entire period, small caps achieved an annual average of 1.4% higher appreciation than large caps, and the current cycle of outperforming large companies has been going on for quite some time. However, as investors, we can't expect a change in trend just because it lasts a long time, and that's how it's worked historically. As an investor, I need a realistic grasp of the investment thesis, why this trend should reverse in the coming months, even if only for a short period of time. So why should small caps outperform the S&P 500 index and Magnificent 7 shares in the coming months and years? Well, we can find a few reasons. First of all, there is the fact that US small caps are currently very cheap. If we compare the difference between the price to earning ratio between small caps and large caps, we're at levels we have only been at once since 1985, just before the dot-com bubble burst at the turn of the century. But the difference alone may not be telling. After all, at the time of the dot-com bubble, the largest position in the S&P 500 were made up of completely different companies belonging to other, often cyclical sectors, General Electric's banks such as Bank of America or Citibank, or oil companies such as ExxonMobil. Today, the largest positions are mostly in the technology sector and companies that generate profits on a completely different principle. So maybe the valuation difference is logical and justified. But the actual valuation of small caps is lower than their historical average, and even if we are no longer at the levels of the crisis year of 2022 at the turn of 2022 and 2023, we are still nowhere near the peaks that small caps reached in 2021. And this is where small caps differ significantly from the rest of the US stock market. In reality, we still buy small caps at a discount today, which cannot be said at all about those big companies like Magnificent Seven. And now I'm sure some of you are thinking of the argument that the reason small caps are cheaper is because of lower revenue growth and structural problems. But that's not true. Sales growth was similar to the biggest companies, even slightly higher. So, if there is nothing wrong with small caps as such, why are they still below the values of 2021? The answer is directly offered. What happened at the end of 2021 and why did the stock market fall? High inflation and increasing interest rates by the Fed associated with the risk of recession. Well, here are we at the real reason. If we look at the periods when small caps lagged behind the large companies from 1930 onwards, despite all the possible differences in the different periods, we come to one common factor: rising inflation moving about 3%. That is a factor that the Fed usually responds to by raising interest rates, which makes it more expensive for companies to finance and borrow. That is something that is critical for small caps that need to expand their business. And where do we currently stand on this issue? Inflation in the US is falling, and the Fed has practically confirmed to us in its statements that it will start cutting interest rates in September. In other words, two things that are real: bull impulse for small companies, to which they already responded with enormous growth at the turn of July and August. Growth, which however has already been interrupted twice in the last 2 months due to fears that the Fed has fallen asleep in lowering interest rates and the US economy and thus entering a recession. But is this recession itself really so critical to today's small cap investment thesis? No. Again, we have both historical data and current data. Let's take a look at that. First, we will look at the data on the S&P 500 index and its behavior in the following 12 months after the Fed began the cycle of interest rate cuts that we are now at the beginning of. The blue lines are the cases where we didn't experience a recession, and the red lines are the cases when we experience a recession. The red diamond then shows us the biggest drop in the given 12 months after the start of the cycle of interest rate cuts. What can we take away from this? A possible recession will indeed cause higher volatility, but if everything is in order with the economy as such, and compared to the crisis of the 1970s or the 2000s in the USA, today's situation is positive. The S&P 500 also managed to grow by an average of 11% if we didn't experience a recession, and by 8% if we didn't experience a recession. How does this relate to small caps? On this chart, we see the difference in the returns between small cap and large cap over the 1 up to 12 months period, both before and after the first interest rate cut. And while the performance in the months before the interest rate cut is significantly against small caps, after the reduction of interest rates, there is almost a 70% chance of the annual performance that small caps will give me a higher return than large caps, on average by 1% higher. Here we also see what we have seen in the markets in past periods: small caps outperforming about a month before the start of the rate cut cycle. And if we compare the outperforming of small caps to those periods when we experienced a recession after the interest rate cut and the S&P 500 index fell more significantly, then it practically always started a period within a year in which it was small company that significantly outperformed. So that does mean the small cap ETF will outperform large caps indices such as S&P 500 in the coming months or years. No, although this outperformance is highly probable, and I personally have been betting on it in my retirement portfolio since last fall. On the other hand, you also need to look at the negative side of things. In recent years, the S&P 500 index itself has been outperformed by only a few companies. If I then weigh the S&P 500 index and all its companies equally in this index, not according to market capitalization, and compare it with the classic S&P 500 index, I see a significant discount in valuations compared to the ordinary S&P 500 index. It means that the majority of the companies in the S&P 500 are still trading cheaply, and that a significant number of these companies could benefit significantly from a cutting in interest rates, especially as a result of capital spillover from safe treasury bills or government bonds to the more defensive stock quoted in the index the S&P 500 contains, and which are now often traded at interesting valuations. The spillover and difference in valuations could result in the fact that the S&P 500 index will not significantly lag behind the small cap indices, at least in the coming months. On the other hand, capital will gradually flow into the riskier and more volatile assets, whether it's cryptocurrencies or small caps. Investors are looking for above average returns, and they will be looking for them. And in the period of economic expansion that probably awaits us, unless some unforeseen situation occurs, we will also see the transfer of capital to these assets. Once again, we are approaching the time when, in addition to videos with a red down chart, a panicked face with flames in its eyes, titled The Greatest Crash in History, we will also see videos titled These 5 stocks will make 10x in half a year, and these stocks are one of the world, practically always in the small cap camp. More speculators will enter the market and prices will rise, and that groups will probably outpace the big companies, at least for a while before the cycle turns in favor of large caps again. So the main question is, can you prepare your portfolio for this situation? For sure not to sell your ETF to those large cap indexes and not to buy in bulk the Russell 2000 or other small cap variations. On the other hand, it is worth considering whether it wouldn't be better to include more small caps in your regular investment for some time, or not to slightly overweight their position in the portfolio, and which ETF to choose for that. Probably the best choice in terms of price-performance ratio is within the UCITS variant ETF with the ticker symbols at PRV, which tracks the MSCI USR Small Caps Index and ranks the shares in it according to valuation metrics. This ETF manages to outperform the classic Russell 2000 Small Cap Index, and at least in the UCITS variants, it is an efficient and high-quality option to include quality small caps in the portfolio. The difference in performance is due to the fact that valuation metrics effectively filter out small caps that are subject to pointless speculation or that are close to collapse. If you are an investor who wants to try this investment thesis with leverage and who has a high tolerance for volatility and risk, and who also has access to American ETFs, then there are still relatively an interesting option that I have been regularly accumulating for several months in my pension portfolio. That option is a leveraged version of an ETF tracking the Russell 2000 index. In my particular case, an ETF is ticker symbol TNA. However, a leveraged ETF, especially one for small caps, is definitely not for everyone, even though it is an interesting option to ride on the eventual outperforming of small caps in the coming months or years, if of course today's investment thesis comes true. What do you think of the outperforming of small caps in the US in the coming months? Do you think that small companies can outperform the S&P 500 index for some time? Let me know what you think in the comments. I will also be happy for any feedback, whether in the form of likes or comments. If you don't want to miss other videos from the world of finance and investing, subscribe to my channel. Have a great time and see you!